What's going on? Alex here, and today I'm answering your tax questions from Reddit. And today's question has to do with the long-term capital gains rates and how they work in relationship to the income tax brackets. There's a lot of confusion in this area, and this is a very common question, so let's get to it. All right, so this question comes from Second Zero. Hey guys, I had a question I'd like clarification on. I'm invested in the stock market and looked up the long-term capital gains rates on this site. And the site this person is referring to is the NerdWallet site here with the 2020 capital gains tax rates. And you can see here that for the 0% rate, it shows that your income would have to be 0 to 40,000. Now, how does that work? We'll get to it. It says that for a single filer making less than 40,000 per year, their long-term capital gains rate is 0%. This doesn't make sense to me. What if I sell $1 million worth of Apple stock after holding onto it for 10 years, making $35,000 a year? Unusual situation, but play along. That means I could theoretically pay no tax on that massive stock sale. Am I missing something here? Isn't that a loophole? Would appreciate any clarification. I can't tell you how much confusion there is over this particular area. You have many individuals going to, let's say, this website. There are many like it, but this one is mine. No, it really isn't. But the key here is that they see that the long-term capital gains rate is 0 for income from 0 to 40,000, 15% from 40,000 to 441,000, and 20% for 441,000 and more. Here's the big misconception. This income includes the long-term capital gains that you're recognizing in a particular year, plus your interest, plus your dividends, W-2 wages, all that other stuff. All of that gets combined to determine what the long-term capital gains rate happens to be. All right? And essentially, the idea is that if you have $35,000 in other income, it's a little more technical than this, but very basically, if your income is $35,000 and you have $10,000 in long-term capital gains, then 5,000 of those are going to be taxed at the 0% rate, and the other 5,000 will be taxed at the 15% rate. So you've crossed the threshold from here to here, and your long-term capital gains, meaning gains on assets that you've held for longer than a year and a day, will be taxed at both rates. So some of it at 0%, some of it at the 15% rate. So that's the big issue, is that this income amount already includes those long-term capital gains, not your other income aside from long-term capital gains. It includes it. So that's a key point. So with that said, let's kind of play out this scenario. And while this website is good, I actually like a different site. So Bankrate.com has the 2019 amounts and the 2020 amounts clearly laid out here. Let me just make sure you guys could see it. Okay, so there's 2020, here's 2019. And the reason I'm pointing out both is that for the single filing status for 2019, the key number is 39,375, while for 2020, the key number there is 40,000. The reason I'm looking at 2019 is because the tax software that I'm about to pull up here is for 2019. But I wanted you to see that while the numbers are a little different, they're talking about the same thing. Okay, so 39,375 versus 40,000. We're talking about the same thing, just two different tax years. All right. So let's take a look at the scenario that this person described. And this is a 2019 tax return, single filing status, nothing too fancy. And quite simply, there's $35,000 in wages, and there's the disposition of Apple stock. Now, we're assuming that this stock was acquired in the year 2000, so longer than a year and a day. Really doesn't matter the specific holding period beyond that. The date sold is 1/1/2019. Again, this is the 2019 tax software. And the sale price is $1 million, but we're assuming a basis of 0. The whole idea here is to see how the long-term capital gains function. So cost basis really doesn't play a key role here. So let's just assume 0. Let's really push this thing to the max and see what happens. Now, in terms of what the tax return looks like, we have $35,000 in wages. Then we have the $1 million from the sale of the stock. This would be a long-term capital gain. And you could see that on the 1040 here, the total tax is $217,000. All right. So clearly you could tell that the long-term capital gains rates are definitely being applied to this stock sale And it's not that you get a freebie on all of these gains just because your other income was below $40,000. That's not how it works. So for additional details on how all of this functions, we can take a look at the worksheet here. This is the Qualified Dividends and Capital Gain Tax Worksheet. And this gives us some valuable insights. Now, the first thing we look for is the amount taxed at 0%. So this is the amount of capital gains taxed at 0%. So you see $16,575. Now, again, I told you that there are a few different dynamics at work here that would change the specific amounts. Calculations have been involved. But anyway, the point is that the 0% rate is being shown here. This is the amount taxed at 0%. Okay. And you have the 15% rate here. Okay, so that's the amount of tax there. And then you have the 20% rate here. Okay, so it's all being taken into account. You're not getting a freebie. It's very much tax intensive, this transaction. So that is resulting in the total tax liability of about $217,000 right here on the return. It's important to keep in mind there are a lot of other taxes at work, so this is not just clean long-term capital gains, because a few other considerations when you sell a significant amount of stock could be AMT, or alternative minimum tax, and in this simple example, there is some AMT that is applicable. Aside from that, you have the net investment income tax. Oh, this is a doozy to people selling a lot of stock in a single year, because this is essentially a 3.8% tax on the gains. So that's another $31,730 that you have the privilege of paying in this transaction. So it's not just clean long-term capital gains. There are some other taxes that are playing into it. But the important point is that you need to consider the long-term capital gains along with all of your other income to figure out what rate your gains will be taxed at the federal level. Now, again, for at the state level, let's remember that a lot of states do not have a preferential tax rate for long-term capital gains, so much of those gains will be ordinary income. Some states do have a preferential rate, most states do not. So keep that in mind and make sure at the state level that you're covering your bases as well. But that is a real-life example, so to speak, on an actual tax return of how this all can play out. So hopefully, second zero, this advice will help you add many zeros to your net worth over time and give you a better understanding of how this long-term capital gains rate works. And I see this confusion all the time, and I could see where it comes from. Kind of isn't very intuitive, but once you know how it functions, I think it's like riding a bicycle. It's just something that stays with you, all right? And again, key point to keep in mind that these amounts do get adjusted year to year, so just bear with me when it comes to 2019 versus 2020. Those amounts may change, so just look it up, figure out which rates will be applicable for your long-term capital gains, and you'll be all set for being an absolute billionaire. With that said, if you found value in this video, feel free to hit that like button, subscribe to the channel, leave a comment, share the video, do all those YouTube-y things, and I want to tell you, I appreciate you guys. Hopefully this was helpful. Thanks for watching.